Welcome to TheoTrade. This is Don Kaufman. It's February 8th, 2019, and you are watching the TheoTrade Weekend Update. Allow me to begin with an invitation to each and every one of you to our third annual event right here in Scottsdale, Arizona. Yeah, it's all on the schedule. All the details, of course, to follow this video. But that event, May 30th through June 1st, right here in Scottsdale, Arizona. The web address to attend live, TheoTrade.com/live. Again, that's TheoTrade.com/live. All the event details to follow this video. With that, let's get into it. Let's talk a little bit about kind of our the week at large and really what we're anticipating this next week. First of all, let's talk a little bit about the S&P 500, which finished the week massively unchanged. You know, I look forward to effectively saying that, hey, I would have preferred maybe a little sell-off this week, and we got some volatility later in the week, but at the same time, I got to say massively unchanged. What I'm actually referencing, if you look at, well, today, which is February 8th, and looked at the previous Friday, the S&Ps have moved basically a point. Now, obviously, there was a lot of oscillation throughout the course of the week. We even felt a little bit of fear on Thursday. That was, of course, yesterday's trading session to see some sell-side activity in the S&Ps. One thing, though, that's really surprising to me is, given the fact that we did see some volatility on Thursday and Friday of this week, the expected move for next week, again, for those of you that don't speak geek, what's the expected move? It's how the option market kind of depicts risk in the marketplace. The expected move for the week that we just finished was right around 40 bucks. The expected move for this coming week is about $41. What gives? Okay, what are we, completely immune to any sense of volatility whatsoever? Now, quite possibly, this next week of trade, let's just, cut through it and get right to it. This next week of trade that's coming up is, the only way I can describe it is just political limbo week. What do I mean by that? Well, we still have Brexit negotiations, if you want to call it that, going on. So shelve it, put it aside. This past week, and again, more information coming this next week on India. Why do I even bother mentioning India? I haven't mentioned that, in previous videos. India did a surprise rate cut this week, which kind of shocked markets, and people talked a lot about trade wars and so forth, which I'll get to in a moment, that caused some sell-side activity. But India actually sparked some fear into the again, currency markets. They did a surprise rate cut. Again, it sparked a number of events to follow, but a lot of that rate cut in India, and again, if you're cutting rates, maybe you're slowing down, it looks like it was politically motivated. That's why I kind of call this next week, it's political limbo week. So again, we'll put India aside even for right now. What else do we have? Well, we have, China trade war discussion coming up, of course. That's what really is kind of blamed for some of the sell-side activity on Thursday. You can expect to hear more about that. Effectively, the Chinese markets were closed most of this week. Why? It's Year of the Pig. No, really, that's the reasoning behind Chinese markets being closed. Of course, it's the new year there. They'll be back in business this next week, and I'm sure they'll be firing off all kinds of liquidity into their markets. What am I saying by that? I mean, China at this point, if you're looking at it, falling apart at the seams a little bit in terms of economically, but at the exact same time, you'd never know it because they just got the fire hose wide open and they're just pouring liquidity into their markets. That's actually why I wanted to make a mention of it in terms of this political limbo that we're going to be seeing this next week. I would fully expect China to be back on, okay, and with the spigot wide open in terms of their own version of quantitative easing in the markets this week. Last, but definitely not least, the best part of political limbo week, and that's what's coming up. We're just nicknaming it political limbo week. Government shutdown. Yeah, we have to hear about it all over again. Listen, I don't care what side of the aisle you're on, okay? Everybody's heard enough, and it's causing markets, obviously, some undue duress. Now, with all of that being said, again, a lot of uncertainty. Again, the expected move in this next week of trade is only 41 bucks. Which, for those of you, again, if you don't speak geek, if you don't have a great memory for this stuff, that's not a very large expected move. I mean, that's kind of saying like, there's another week, who cares, okay? The last thing I want to talk about on this video, before we actually jump into the charts, before I show you some really in-depth kind of trade ideas and so forth, has a lot to do, okay, with the most recent rally. When I'm talking about the most recent rally, the rally that kicked off in the end of December, really going from, let's just quantify it, from about 2,300 in the S&Ps all the way back to where we're effectively at, which is roughly 2,700. So you get this, 400-point rally, but there's something very large that most people are missing about this rally, and I'm going to show you this in depth. And it's something that I was talking about political limbo, but this leaves me in like kind of trader limbo. That has everything to do with the volatility futures. Okay, I've seen all kinds of rallies back, and especially in the last few years. I mean, we saw, a wild volatility event in the beginning of 2018. Don't worry, we rallied back from that. Again, we saw all kinds of sell-side activity, for example, all the way back into 2016. Don't worry, we rallied back from it. But there's one key component that is missing from this most recent rally, and it's everything to do with the volatility futures. The structure of volatility refuses to normalize. Until it does, okay, I'm not out there buying nothing at this point in time. Again, volatility tells a vastly different story than any previous rally that we've seen in any recent years. And of course, people can point out, well, quantitative tightening is going on and this is going on. Again, most of that was going on in some of the recent sell-offs as well. When we bounce back, volatility normalized. What I'm going to show you here momentarily, okay, is, again, it's a little bit of a geek fest. Bear with me. Let me get into it because it is what drives a tremendous amount of trade on the professional side. With that, we're going to go ahead. We're going to show you some trades. We're going to show you some charts. More importantly, we're also going to talk a little bit about our live event. Stay tuned. To the charts and trades we go. Allow us to start here on the S&P 500 futures. I say this all the time, but not everybody necessarily looks at the futures or the futures products. Maybe you never intended to trade futures products, but it's imperative to understand that the futures, they drive order flow to the marketplace. And why I'm bringing up the futures is because our gravity points are so very much in play throughout the course of most of the recent trade. But this week was all about pinging back and forth amongst these gravity points. And again, last week we saw 26.26 in play, 26.82, and of course 27.31. If I tighten up the time frame here, we're going to actually cruise over to a 30-day 1 hour. When I'm talking about pinging back and forth between gravity points, effectively what I'm actually saying and what we're anticipating in the marketplace is when we step off one gravity point, we start to actually come up off the gravity point. We literally ping to the next gravity point. We resonate there for a period of time, pull back in, and continue the process time and again. I mean, look no further here than this is the 26.26 gravity point. We came all the way up to what? Okay, that happens to be none other than 26.82. Okay, pulled back into 26.26, rallied back, pulled back, all the way back up to the to the gravity point, back down to it. Then we actually shot again all the way to 27.31. I mean, I can go all day about these gravity points. You have to have these levels because not only are they tradable levels. Okay, once you hit one of those levels, you could basically just, again, if you trade intraday, hands off the mouse, because when we hit one of the gravity points, we just basically resonate on that gravity point for a considerable period of time or until a tweet knocks us off that gravity point. Nevertheless, I wanted to explain a little bit about that inside of the S&P 500 because, again, that's what's driving order flow right now. And knowing, okay, almost precisely to the penny where we're actually going from one level to the next is, again, it's imperative in some of the trade that we're seeing. And these gravity points have been in play, as I said, for about 18 months. But all we've effectively done in the midst of all this volatility is just ping from gravity point to gravity point. When we broke off to 25.75 all the way back here in December, I mean, that got serious. But right now, where are we back in? Kind of back into the comfortable volatility box, better known as the hurt locker. So let's move on from the S&P futures and cruise over to the SPX. Okay, because the SPX is where we actually track our expected moves, and I couldn't stress this enough in the video portion. But the S&Ps this week, what did they do? Absolutely nothing. So to characterize exactly that, all right, here's this is the week at large where we effectively started and ended the week is exactly the same number. And again, the thing that kind of surprised me is given the fact that we had some volatility, just a little volatility on Thursday, a little bit of volatility today, which of course is Friday, it surprised me that the expected move in this next week of trade. So we're all clear, okay? Yes, every week we generate an expected move before the week begins. This expected move, okay, is brought directly from, okay, the options chain. It's about $41. Let's call it $41. The previous week was right around $40. So even though we saw some sell-side activity, we didn't really see an expansion in volatility. So once again, to err on the side of caution, I strongly suggest that you not necessarily go out and sell some premium. Okay, why? A $40 move, right? A $40 move. Again, we were throwing off what? 30-point moves, on an intraday basis. That should make you nervous because, again, if you're selling options for a week, and you collect $40 for the entire week, we're capable of moving $30, $35, $40 in a day. What's the point? What gives? Okay, that is not going to be a decent trade for you in the end. So again, in the SPX, okay, I want that to kind of resonate with people. I am not a seller of premium. Again, not a seller of premium inside of the SPX. Now, let's move on a little bit from the SPX. Again, not everybody necessarily trades the SPX, which is just fine with us. The next thing I want to move into happens to be none other than the XLF. Okay, what is that? It's the financials. Now, I know Corey Rosenblum has been talking extensively about the financials as well in a couple of recent videos. The financials, though, I'm telling you, this holds the key to the S&P 500. You want to know the next move in the S&P 500? I know everybody's got their head stuck right there, this is the technology. It's Microsoft and it's Apple and it's Amazon, it's Google. Oh my, okay? But the S&P 500, okay? What's really hanging it up and holding it up right now? It's right here inside of the financials. If you look at the progression of the S&P 500, okay, the S&P 500 again kind of stalled out in the most recent week or two of trade. You still saw a little bit of buy side activity in the previous week, and again we've kind of stalled out over here. What's actually holding the S&Ps back at this point in time, though, is most definitively it is the financials, and the financials threw off a little bit of volatility the last couple of trading sessions. This is one of the reasons I'm surprised that the S&Ps didn't have more volatility packed into them. So does this mean that the financials have rolled over? Not necessarily so. Let's not get ahead of ourselves but just by looking at this chart, we're like, okay, it rolled over. Does that mean we're going to have, increased sell side activity? Absolutely unequivocally no. In fact, if you do read into charts, it's a doji. I don't want to go detailed into this. I just want to show you the increased volatility inside of the XLF, okay, and get you looking at the right product, in this next week of trade, as I called it, political limbo. Yeah, well, political limbo tends to find its way right into the financials because that's where the political limbo is effectively going to play out a tremendous amount. Another aspect to look at is again, the implied volatility inside of the financials, indicating only about a 55-cent move for this next week. That's also, I stand back from this and I look at all the political turmoil going on. There's so much stuff going on, you couldn't even point your finger at it. Again, it's India, it's Brexit, it's trade wars, it's government shutdown, cats and dogs living together, it's year of the pig. At the same time, how could we only have an 18% volatility inside of the financials? It seems low, okay, given the fact that, look at the high to low just from today's trading session. I mean, we're down here at what, 25.34, a high somewhere around like almost 25.80. Last time I looked, it's thrown off almost 50 cents in a day, and I'm supposed to believe it's only supposed to move 54 cents in an entire week. Again, I'm not being a seller of any financials, okay, and when I say a seller of premium inside those financials. So I wanted to go through that. All right. Now, let's move onward and upward, really to the theme of this entire video. And the theme of the video is, here's kind of what's missing in this most recent rally. And I wanted to spend a couple of minutes on this because I've touched on it maybe lightly in some recent videos, and it's just something that just looms large and kind of resonates with me. So I guess you could call this it's a V bottom. So a spectacular move to the downside followed by a spectacular move to the upside. But the spectacular move to the upside is missing one very key component, and that is, the volatility, refuses to normalize. When I say refuses to normalize, this is just looking at a chart of the volatility, contract. And by the way, the contract constantly kind of rolls over. Volatility is just the inverse, if you will, of what the spiders did. But what I'm actually talking about is the structure of volatility. It's actually often referred to as kind of a depth curve. So I'm going to close up this left side bar, and I'm going to draw it out for you here real quick. So when we look at volatility, and specifically these volatility futures, what can you kind of look at? What can you expect with this? First of all, again, not everybody necessarily trades volatility futures, and it's absolutely fine. But these volatility futures, the reason they're so important, and they're far more important to me than the VIX. Listen, the VIX is nothing more than a calculation. It's a calculation of what? SPX, 30-day volatility. That's what the VIX happens to be. But when you look at stuff like the VIX options are actually priced, from the volatility futures. So this is a tradable, a tangible product. So when somebody really wants to come in and they say like, oh, I want to buy me some volatility, they don't go to the VIX. Yeah, they can go into VIX options. They could buy VIX options, no problem. When they go in though and they want to buy volatility, you know what they do? They buy volatility futures. They're either buying them in March, so there's March volatility futures, and there's April, and there's May, and there's June. Exclude, these volatility options that are, or I should say futures that are zero bid, but there's big contract size in the rest of the volatility contracts. Nevertheless, you could buy March or April or May or June, and it's the actual structure, and the differentiation between, for instance, March and April and May and June, that is disconcerting to say the least. Given the fact that most recently the S&Ps went like that. That would be the spiders. And if the spiders rally, what you would anticipate is the short duration volatility. This happens to be right there, a 39-day contract. You would expect that the 39-day contract would drop substantially below this, 60-day contract. Why? Because the risk in the near term may be not as large as the risk in the future, and the risk kind of grows because the more time you have, and here's 131 days out, the more time you have, the more uncertainty, the marketplace should generate. So most of the time, after kind of a wicked rally like we've seen, the volatility contracts would look like this. Where the short duration volatility maybe is at 17, a little longer out on the curve, maybe jumps to like 18, 20, a little further on the curve, maybe jumps to like 19. Before you know it, you're at 19, 30. That's what the volatility curve often looks like after a wicked rally up in the spiders. What does the volatility kind of curve look like right now? Kind of looks like this. It's flat, which indicates the risk today is the same as the risk out here. What that does, to traders is it should put you on edge every single step of the way, because as soon as these volatility futures, they could invert. In fact, earlier today, the volatility futures were inverted. Like the 39-day was above and beyond like the 68-day. As soon as those volatility futures invert, it changes the whole dynamic of the marketplace. It changes how market-making firms hedge. That's something I could do a really specific or express session on here at TheoTrade. Obviously, in this video, don't necessarily have time to do that, but because the volatility futures are flat, they should have normalized. They didn't normalize. Where does it leave us? It leaves the entire market in limbo. And that's actually why I keep talking about this. It's political limbo. It's market limbo. It's the volatility refuses to normalize. What that leads me, to do, I want to take volatility shots. When I say I want to take a volatility shot, this is what the kind of trades that we do. We would use stuff okay, like a risk twist spread. Now, this is something I've talked about extensively inside of TheoTrade. I'm more than happy to create risk twist spreads for all the TheoTrade members. A risk twist spread, which takes, again, a big downside shot in the marketplace. It's not saying that like we're outright, hideously bearish. It says, okay, we're going to risk a very small amount of capital. Actually, I put on some risk twists earlier this week and we paid, okay, anywhere from like $1.60 to about $1.80 for them. Those $1.60 or $1.80 bets can be worth, okay, $10 plus. Okay, how? It just takes, again, this wicked downside shot, and it's worth taking, okay, that minimal amount of risk to go for a $10 kind of reward. That's a risk twist spread. And if the marketplace rallies up from here, so be it. What happens? Well, your $1.60 may evaporate, okay, but that's a small price to pay. By the way, that $1.60, that's good for an entire quarter. All right, that's not good for like 30 days, not good for like 60 days. That's good for a full quarter. Okay. On top of it, I'm not done. On top of it, I also want to be a buyer of volatility in the VIX itself. Okay. You're like, what? A buyer of volatility in the VIX? Why would I want to buy volatility in the VIX? Again, I have no love for the VIX. I have no love for the VIX options, but I can tell you one thing, the VVIX, which is the volatility of the volatility index, and I talked about this earlier last week. Okay. It's low. The volatility on the VIX itself is low. So it's led us to actually want to be buying volatility options. And you can see I've got all kinds of positions in here. I'm selling put spreads to actually finance the purchase of calls. And here I'm using VIX volatility spreads. It's a party, people. But you better believe I want to be net long volatility in the VIX. I think at this point in time, with the marketplace in a little bit of limbo, taking some of those what I term outside shots on volatility. Why do I call them outside shots? Listen, a thing like a risk twist spread, okay? Yeah, you pay $1.60 for it. It could be worth $10, okay? Going out and buying, all right, volatility in the VIX, you realize the VIX, where I bought volatility out here, where I bought volatility right there, okay? I'm buying like what? Like a 70 vol? Okay? The VIX recently has had spikes in volatility, okay, through the roof. You're like, well, where has volatility actually gone, okay? Well, recently, 147, okay? Even more recently, 110. That volatility takes off to the upside, and it is going to be a happy day. And that's worth it to take a very minimal amount of risk, take those outside shot kind of trades. And with that, as I said, this week, there's a whole lot of like limbo that we're going to be left in. Okay, it's going to be, Twitter bomb after Twitter bomb this week. We should expect a lot more news coming out of China. With that, let's talk a bit about our live event. It's back for the third year in a row. TheoTrade will present Volatility Strikes Back. As I said, this is our third annual event. It's TheoTrade 2019 right here in Scottsdale, Arizona. Check out the link. It's theotrade.com/live. Again, it's theotrade.com/live. We are kicking off the live event on May 30th. Okay, so it's actually going to kick off on a Thursday kind of evening. The seats for this event, they're $997. You're not going to find that anywhere for any live events. And we have all of our instructors going to this live event, which I will mention here momentarily. Our VIP is already sold out. Our first tier seating is already sold out. Get in and get in early. We also have a block of rooms at a spectacular rate. Listen, Scottsdale, Arizona, okay, coming into the end of the May is still not inexpensive. We put together a spectacular package and room block for you, including breakfast. We'll serve lunch at the event. We have a cocktail party. It's $997, which, as I said, for a live event for 2.5 days is unbeatable. People have paid $5,000. Okay, for 2-day events. We do this because we want to sit down, we want to meet all of our members, and we're going to make ourselves as available as possible at the event. Don Kaufman, that's me, Professor Jeff Bierman, Corey Rosenblum, Tony Rago, Brandon Chapman, and Matt Williamson. Also, most of our staff from here in Scottsdale will be at this event. If you want to meet a couple of our staff or any of our crew, you have questions one-on-one, as I said, we're going to make ourselves available through all the hours of this event. So it kicks off May 30th, 7 to 9. It's called Cocktails and Trading. It's actually going to be Jeff Bierman and myself, kind of a little bit of live and unleashed. Our live sessions are going to run, that's Friday, May 31st, 9 to 5, and then Saturday, June 1st, from 9 to 5. If you're interested in very detailed topics, here they are. Everything from Volatility Strikes Back. Yes, I'm going to be kicking off the theme of this event, Volatility Strikes Back. Again, that's going to be me. Extreme measures, technical indicator setups to exploit price volatility. Okay, maybe you're more into trading the Nasdaq. Ready, set, and cue with Tony Rago. I'm also going to jump forward and tell you this. We have a really cool session planned where Tony Rago is actually going to do a session with Corey Rosenblum. I'm going to do a session with Jeff Bierman. It's kind of when quantitative traders meet chart geeks. Okay, Brandon Chapman inside the VIX and volatility structure. It does not stop. On Saturday, off the record, I'm going to be kicking off the morning with that. That's what this is stuff that we don't want to record. So that's when I say it's off the record, we're going to go, as I said, unleash, unfiltered, and uncensored at that particular thing. It's going to be the depths of trading unlike you've never heard before. This is also the session I was talking about a moment ago, Love at First Spot. That's where trend meets NQ. That's Corey Rosenblum and Tony Rago. I'm really excited about that session. Also, for the first time ever, we're going to have Matt Williamson joining us at the live event. He's going to be talking about the taming of the skew. This is going to be, a not miss event. Do not miss this event. I think you guys are going to love what we put together. The third time is going to be the charm in this event. If you thought for those of you that did go to the first two events, you thought those were spectacular, just wait. We have a tremendous amount planned for this. It's TheoTrade.com/live. Obviously, I'm a little bit excited about it because you know what? We don't go out too often. A lot of the times we're talking to you guys on videos. We're talking to you live in the TheoTrade chat room. Well, here's our chance for you to come out, to meet a lot of us, to spend 2.5, 3 days with us. Please sign up now, TheoTrade.com/live. Thanks everybody for joining us here on the Weekend Update.